This is the moment XRP holders train their patience for, the moment years of ridicule, sideways boredom, and lawsuit-induced suppression finally compress into one violent wealth transfer window. While the rest of the market is only now squinting at the XRP chart asking, "Did I miss it?" You're early to why this move is still structurally underpriced. What looks like a big run to casual traders is still just pressure bleeding from the most extended, legally handicapped, institutionally incubated coil in large-cap crypto. Because here's the hard truth almost nobody outside the serious XRP base internalized. Multi-year underperformance plus forced exile, delistings, plus regulatory uncertainty plus infrastructure quietly upgrading in the dark equals the most asymmetric late-cycle expansion fuel you can engineer. That fuel is still mostly unburned. And by the time the crowd accepts XRP isn't the dead banker coin, the latter is already missing its lower rungs. Stay locked in. We're going layer by layer through 1, the structural setup that manufactured the spring, 2, the legal and legitimacy catalyst wall that just detonated, 3, the utility flywheel, real flows, tokenization, stablecoins, EVM, AMM, that makes velocity sustainable, 4, the incoming capital pipelines, ETFs, treasuries, corridor expansion, macro rotation, 5, smart positioning framework so you don't emotionally round-trip life-changing gains, and 6, the endgame scenario too few are modeling XRP's unique path to repricing not as a speculative meme, but as a critical piece of settlement infrastructure in a value internet era. If you're serious about asymmetric crypto plays with actual fundamental flywheels, lock in now, subscribe to Be Crypto Smart, hit the bell, because the difference between reacting to headlines and front-running structural inevitabilities is the difference between incremental gains and generational moves. Let's dig in. The utility flywheel, real-world flows, tokenization and programmable extensions. Utility versus narrative speculative cycles, misprice narrative potential ahead of utility. XRP inverted that arc. Narrative was suppressed while underlying utility rails advanced. That inversion sets up a durable expansion because adoption metrics can sustain valuation recalibration rather than relying on reflex hype alone. Let's break the emerging utility pillars and assemble a flywheel. Real-time cross-border settlement, original core. On-demand liquidity, ODL corridors reduce the need for pre-funded Nostro accounts. Cost savings plus working capital release equals tangible corporate finance ROI. As corridor throughput scales, transactional demand becomes programmatic, less sensitive to speculative volatility because usage is function-driven. Each incremental corridor, regional PSPs, remittance operators, fintech banks, increases baseline daily aggregate XRP volume anchored in non-speculative flows. Baseline volume stabilizes order books, reducing tail risk for large buyers. Stablecoins on XRPL. Stablecoin issuers launching on XRPL are demand multipliers. Why? 1. They bring users needing frictionless settlement. 2. They anchor unit of account stability for DeFi primitives. 3. They enable multi-asset routing. Stablecoin left-right arrow XRP left-right arrow fiat, increasing pathfinding efficiency. Each stablecoin pool deepens liquidity rings around XRP pairs, improving slippage for institutional FX bridging. Indirect effect. As stablecoin velocity on XRPL climbs, arbitrageurs hold XRP inventory to optimize routing, a working inventory demand layer distinct from speculative holdings. Tokenization/RWAs, real-world assets. Tokenizing yield-bearing instruments, treasuries, commercial paper, real estate fractions, or alternative assets on XRPL taps into multi-trillion TAM categories. The key isn't hype. It's settlement interoperability. Tokenized assets require friction-minimized transfer and redemption rails. Integrating with existing payment corridors shortens redemption cycles, raising capital efficiency. Every tokenized RWA minted in an XRPL environment is potential collateral for DeFi settlement loops requiring XRP as a bridging or fee asset. EVM sidechain/compatibility layer. EVM compatibility, sidechain or integrated execution environments, invites the vast existing Solidity developer base. Lowering migration friction compresses the timeline for liquidity bootstrapping of standard DeFi primitives. DEXs, lending, derivatives. As TVL seeds, demand for native bridging asset liquidity, XRP, rises because pairing depth underpins user experience. Slippage, Price impact. Importantly, an EVM environment pipeline's composability. Stablecoins plus tokenized RWAs plus NFTs plus AMM plus hooks equals layered use cases. Native AMM and liquidity incentive architecture. XRPL's approach to AMM, including potential continuous auction mechanisms to mitigate impermanent loss, is structurally differentiated. If execution efficiency plus IL optimization attract professional LP capital, on-ledger price discovery tightens. Better on-ledger price accuracy reduces routing leakage to external venues, increasing internal flow retention, which amplifies fee accrual and justifies more market-making inventory. More inventory equals tighter spreads equals more enterprise comfort with size. Hooks and programmability. Lightweight smart contract logic, hooks, allows event-driven behaviors, auto-sweeps, conditional payments, compliance checks, without requiring full Turing-complete overhead for simpler use cases. That fosters embedded finance-style flows. Machine-triggered microsettlements, streaming payments, automated treasury rebalancing. Each automated microtransaction is marginal XRP demand, fee plus path asset. At scale, microsettlement volume dwarfs human-initiated transfers in mature networks. NFTs and specialized asset classes. While speculative NFT mania cooled, utility-centric NFTs, ticketing, access credentials, carbon or energy certificates, are infrastructure plays. High throughput, low-fee minting plus compliance-friendly features position XRPL as a candidate for enterprise credential tokenization. These tokens require transfers. Transfers require fees and routing. XRP benefits indirectly. Data and analytics feedback loop. As dashboards surface real usage KPIs, corridor throughput, stablecoin float, AMM depth, tokenized asset issuance pace, evidence-based conviction strengthens. Data transparency fosters institutional comfort, tightening risk premiums, and unlocking bigger allocations. Putting it together, the utility flywheel. Core settlement corridors scale, stable baseline volume. Stablecoins deploy deepen liquidity, attract users. EVM and programmability accelerate DeFi and dApp experimentation. Tokenized RWAs arrive, introduce yield instruments and collateral demands. AMM plus liquidity incentives, tighten spreads, improve price discovery. Better execution lowers enterprise friction, invites more corridors. Analytics/KPIs publicized, reinforce external confidence. More corridors plus assets plus capital equals stronger baseline. Why this matters for sustained price appreciation. Speculative rallies often crater because demand is front-loaded hype with no structural utility sink to keep tokens off exchanges. XRP's emerging flywheel absorbs circulating supply into working capital roles. Treasury bridging, market-making inventory, liquidity provisioning, pathfinding reserves. Each token held for functional throughput is one less token immediately for sale during fear spikes, muting downside amplitude and enabling higher consolidation floors. Higher floors breed institutional comfort for larger position sizing, a recursive reinforcement. Key takeaway: utility architecture has quietly matured to the point where incremental narrative adoption unlocks compounding functional demand, a structural divergence from past cycles' ephemeral hype. Overlooked vector, algorithmic liquidity routing and machine treasury automation. As automated treasury systems integrate cross-ledger smart routing, they will hold operational XRP inventories to minimize settlement latency. Machines do not FOMO. They rebalance according to algorithmic thresholds. These autonomous microflows create a non-emotional liquidity demand base. The market severely undervalues this vector because it's invisible until aggregated metrics appear. But once combined with stablecoin streams and programmable hooks, machine-driven rebalancing is a persistent drip of incremental demand. Key takeaway: capital inflow vectors are stacked, staggered, and diversified. ETFs, treasuries, corridors, DeFi, tokenization, derivatives, and automation. Their activation timeline overlaps to produce a cumulative demand curve steeper than any single catalyst implies. Strategic positioning. How smart holders ride the arc, not financial advice. It's not enough to be right directionally. Wealth is captured by execution structure. Here's a professional-style mental model, Adapt to your risk tolerance. Tranche architecture, conviction ladder. Break core XRP exposure into 3 strategic tranches. Base infrastructure tranche, unshakable core. Size this at the level you can emotionally hold through 40 to 60% volatility without capitulation. Objective: capture the full secular repricing to utility maturity. Time horizon: multi-year. Exit: partial only upon structural utility saturation signals. When growth rates in corridor metrics plateau materially. Catalyst acceleration tranche, medium-term swing. Accumulates during low volatility consolidations post-breakouts before next catalyst cluster. ETF approvals. Major corridor expansion announcements. EVM TVL inflection. Scales out into overextension blow-offs. Parabolic daily expansion plus volume climax plus funding rate dislocations. Replenish on deep retraces to prior high-volume nodes. Tactical liquidity tranche, active rebalancing. Smaller capital designated for event-driven trades. ETF rumor spikes. Legal filing dates. Macro CPI/Fed decision vol. Objective: harvest incremental percent gains to add to core without new fiat. Catalyst cluster map. Illustrative. Create a rolling 90 to 180-day calendar with anticipated regulatory milestones, exchange product launches, ETF review deadlines, major conference windows, where corporate adoption announcements surface, EVM upgrade milestones, AMM amendment activation windows, large escrow unlock dates, tracked for potential volatility, macro events, rate cuts, USD liquidity shifts. Tag each as flow catalyst, likely to generate net new demand, or volatility catalyst, likely to generate both sides liquidity. Allocate incremental swing exposure before flow catalysts. Scale risk down into volatility catalysts unless asymmetry is skewed. On-chain/off-chain KPI dashboard. Track daily active addresses trend, sustained higher lows post-breakout, corridor transaction counts, stablecoin float on XRPL, EVM sidechain bridging volume, AMM total volume and TVL. Distribution metrics, percentage of supply held by top X addresses over time, derivative open interest versus spot volume ratio. Interpretation: rising utility KPIs concurrent with rising price equals healthy markup. Falling KPIs while price accelerates equals speculative overshoot, rotate part of catalyst tranche out. Profit-taking framework, objective triggers. Predefined scaling ladders now before emotional euphoria distorts rationality. Example: illustrative only at each plus 100% increment above a key structural breakout level. Peel 10 to 15% of catalyst tranche into either stablecoins, for redeploy, or rotation baskets, emerging utility midcaps. If derivatives show extreme funding, e.g., annualized greater than 80 to 100%, and social sentiment spikes, accelerate ladder pace. Do not fully exit core absent evidence of structural thesis invalidation, legal reversal, utility stagnation. Drawdown immunity plan. Assume 30 to 50% pullbacks in a multi-leg expansion. Pre-commit, which price zones represent value reloads, prior consolidation ranges, anchored VWAP from breakout. Set limit orders now. Mechanically executing predetermined bids during fear events converts volatility into position improvement rather than emotional damage. Diversification versus dilution. Holding 40 microcap bets might feel diversified but often dilutes focus and dry powder. In a structural repricing arc for a large cap utility asset, concentrated conviction with risk management can outperform scattershot speculation. Maintain ancillary exposure only if those assets have orthogonal catalysts. Otherwise, they represent opportunity cost against scaling winning theses. Information diet construction. Filter noise. Build a tiered feed. 1. Primary sources. Ripple quarterly reports, amendment proposals, validator votes. 2. Credible ecosystem analytics. 3. Macro liquidity metrics. Global M2 inflection, DXY trend. 4. Reputable legal commentary for post-clarity updates. Demote pure hype sources. Signal quality improves timing precision. Emotional risk checklist. Before altering a core position, ask: did a structural premise change, or did price movement alone trigger discomfort? If only price volatility, default to plan. If structural negative, e.g., major regulatory regression, then reassess core. Codify this logic physically, printed or pinned, to override limbic impulses during turbulence. Rotation strategy, if, when XRP executes major multiples. Late in an expansion leg, rotate profits not principal into infrastructure plays synergistic with XRP's ecosystem, e.g., oracles, compliance tooling, analytic services, that benefit from rising on-ledger volumes. This strategy compounds ecosystem growth while diversifying tail risk of a single asset blow-off reversal. Wealth preservation layer. Phase-in conversions of a portion of realized gains into non-crypto assets or yield-bearing stable instruments to lock life goal progress. Debt elimination. Emergency funds. Asymmetric wins must translate into real-world optionality or the cycle resets with no net lifestyle delta. Key takeaway. Strategy converts a thesis into realized outcomes. Without predefined tranche logic, KPI feedback, and profit/drawdown protocols, even perfect narrative foresight can devolve into emotional churn. You now see the architecture. The pressurized multi-year base wasn't wasted time, it was stored energy. The legitimacy cascade isn't a one-and-done headline, it's a multi-quarter unlocking of risk tiers. The utility flywheel has matured just as capital pipelines prepare to converge. Positioning strategy is the difference between observing the wealth transfer and participating in it. If you found this breakdown clarifying, do the smart thing now. Subscribe to Be Crypto Smart. Smash the notifications so you front-run the next structural catalyst deep dive. Drop a comment. Which utility pillar do you think the market is still mispricing the most? Your perspective might spark the next exploration video. We're early in a repricing arc, most still model with outdated assumptions. Stay objective. Stay data-driven. Stay patient. Final reminder, not financial advice. It's strategic framework design. Execute responsibly. See you in the next one.